On May 15th, the most powerful job in global finance is changing hands. Here's what's happening and exactly what it means for your mortgage, your savings, and your investments. Quick context. Jerome Powell, the chair of the Federal Reserve since 2018, finishes his term on May 15th. His successor, Kevin Warsh, takes over the same day. This is the first major Fed leadership change in 8 years, and arguably the most consequential shift in monetary policy direction in over a decade. Powell took the Fed through 3 massive crises in 8 years. The pandemic, where he cut rates to zero in 2020, the post-COVID inflation surge, where prices peaked at 9.1% in 2022, and constant political pressure on the Fed's independence. He gets mixed grades. Best defender of central bank independence in a generation. But he was also late to act on inflation, calling it transitory for too long. Notably, he's not fully leaving. He stays on the Fed board as a governor, the first outgoing chair to do that since 1948. So who is Kevin Warsh? 56 years old, Stanford undergraduate, Harvard Law. He's actually no stranger to the Fed. He served on the board of governors from 2006 to 2011, which means he was inside the room during the 2008 financial crisis. Historically, he's been what economists call hawkish, meaning he favored higher interest rates to fight inflation. But recently, his tone has shifted. He's argued that productivity gains from artificial intelligence might allow the Fed to lower rates without inflation reigniting. That's a meaningful change. Now the part that matters. 4 things are likely to change. Number 1, the inflation target. Powell's Fed targeted 2%, explicitly. Warsh has said price stability should mean prices change so little that, quote, no one's talking about it, which is vaguer and could mean tolerating slightly higher inflation. 2, the Fed's balance sheet. Warsh wants to shrink it faster, which can actually push your borrowing costs up, even without the Fed raising rates. 3, communication. Warsh hasn't committed to holding press conferences as often as Powell did. And 4, he wants to narrow the Fed's overall role, focusing more on inflation, less on employment and financial stability. But here's what people are getting wrong. A lot will not change. Warsh testified that the Fed will remain, quote, strictly independent. The 12-person committee that actually sets rates. Same people, same rules. Powell is still in the room as a governor, providing institutional continuity. And this is important, most of the expected policy shift is already priced into markets. Bond traders aren't expecting fireworks, they're expecting evolution, not revolution. What does this mean for you concretely? 4 real impacts. First, if you're hoping for big mortgage rate cuts under the new chair, do not hold your breath. Mortgage rates follow long-term Treasury yields, not the Fed's main rate. And if Warsh shrinks the Fed's balance sheet like he wants to, it could push Treasury yields higher, not lower. Second, if you're a saver, this is actually good news. High-yield savings accounts and money market funds should keep paying solid yields around 4%. Third, expect more stock market volatility around Fed announcements while traders relearn what to expect from a new chair. Fourth, and this is the most important, do not change your long-term investment plan based on a Fed leadership change. Here's the part most coverage skips. Look at history. 3 Fed leadership changes in modern memory. Greenspan to Bernanke in 2006. Markets crashed 2 years later, but that was the housing crisis, not Bernanke. Bernanke to Yellen in 2014. Totally smooth handoff. The bull market kept going. Yellen to Powell in 2018. Brief volatility, then strong stock returns. The pattern is clear. Fed chairs change. The mathematics of long-term compounding don't. If you're in a broad index fund, this transition matters way less than the financial press will make you believe. Powell out, Warsh in. The Fed has a new captain, but the ship sails the same. Stay calm, stay invested, and don't make decisions based on the news cycle.